Why we should be looking at the FTSE 250 and not the FTSE 100 to gauge the impact of Brexit. By Ben Wright. Read to you by Brian Jefry. Stop looking at the FTSE 100, everyone. Seriously, stop it. Yes, I know that it only fell around 2.6 PC on Monday and is only 4.5 PC below where it was before the UK's vote to quit the European Union. But, really, if you want to find evidence that the Brexit vote hasn't spooked financial markets, you need to look elsewhere. You may be looking sometime. There are lots of gauges of investor sentiment towards the UK economy. None of them is perfect. But the FTSE 100 index of the largest companies listed in the UK, often called the Footsie, is one of the least perfect around. The key to understanding why is that we're listed. These are companies whose shares trade on the London Stock Exchange, but whose operations are far further flung. Credit Suisse recently calculated that the constituents of the FTSE 100 collectively make around 3/4 of their money beyond these shores. Those revenues are earned in foreign currencies, which must be converted back into sterling for reporting purposes. The weaker the pound, the bigger the relative boost those companies get from those foreign earnings. And sterling has got an awful lot weaker in the last couple of days. This effect has put the brakes on the FTSE 100's recent slide. Furthermore, many of the constituents of the UK's Blue Band Index are miners. They dig stuff up in Africa, price it in dollars and sell it in China. That's a bit of an oversimplification, but you get my point. Brexit is very unlikely to directly affect them. In fact, if the stuff they are digging up is gold, Brexit is actually a positive. Investors have been desperately stockpiling the safe haven asset, and the shares of companies who produce it, since Friday morning. Randgold Resources and Fresnillo, both gold miners, have led the FTSE 100 in the past 2 days, up 26 PC and 22 PC respectively, and, together with other natural resources stocks, have helped cushion the index. This is not an indication that all is rosy for UK plc. A much better gauge of fears about the UK economy is the FTSE 250, which includes smaller and more domestic-focused companies. It fell 7 PC yesterday. This was after it tumbled 7.2 PC on Friday, its worst one-day drop since 1987. In total it has now dropped 13.6 PC since the Brexit vote. There is no firm definition of what constitutes a stock market crash, but a double-digit dip in 2 days is getting awfully close. Banks, house builders and travel stocks have borne the brunt of the pain because they are the most sensitive to the UK economy. Shawbrook, Aldermore, Own Savings Bank and Virgin Money have all lost between 40 PC and 50 PC of their value. Shares in RBS have fallen around 40 PC since the referendum vote, and Taylor Wimpey, the UK's biggest house builder, is off nearly 40 PC. Foxtons and EasyJet have been the first companies to issue profit warnings in the wake of Brexit. These are the companies that will be hardest hit if a falling pound increases inflation, reducing consumer spending, or if unemployment starts ticking up and homeowners struggle to make mortgage payments. On Monday morning, lots of Leave advocates were claiming that the markets were stable and the pound had taken Brexit in their stride. I would argue that a 4.5 PC slide in the FTSE 100 does not constitute stability. But I can see why it might look relatively benign to an untaught eye. Things are a whole lot scarier if you look instead at the FTSE 250. On the pound, which has fallen to a 31-year low against the dollar, I just don't know. The plain fact is that, since hitting $1.50 just after polls closed on Thursday, the pound has dropped nearly 14 PC. Perhaps some people prefer to look at how it is doing against the euro, which is also suffering in the wake of Thursday's vote and has only recently picked itself up following a sovereign debt crisis. Or perhaps they mean the Egyptian pound, which, in fairness, has held up pretty well in recent days.